Hello, Katerina.
Hi, Veljko.
So today we want to talk about something personal and intimate.
I'm ready.
Okay, do you have a financial advisor?
Oh, that is a very personal question.
Yeah, I know it is. We won't talk about your age, but we will talk about your financial advisor.
Not sure which one is more intimate, actually. But drumroll, I do not have a financial advisor. I probably should preface it by saying that we both have a PhD in finance. So I've always managed my own retirement savings. Of course, it's hard to say where I would be with a financial advisor, but we have some information to share with our listeners today in our episode about this. But before we get there, let me ask you the very personal question as well. Do you have a financial advisor?
No, not as such. But as we were preparing for this, it became clear that it's a little bit less of a black and white question. I don't have somebody managing my money.
So you manage your own retirement savings that are sitting in like 401ks, etc.
Correct. In my real estate empire, and absolutely. And no, jokes aside, I do have a tax advisor whose remit and role is not just taking the cash flows as they are, but we have discussions about how to structure investments in ways that are tax advantageous. And that always gets you talking. And that line between tax planning and investment planning becomes thin. And so do I pay anybody to manage my portfolio? No. And yet there is a professional that I pay that, again, he's a tax advisor, but we do run ideas. Of course, what we are hinting at is this is going to be the theme of the episode.
Should you hire a financial advisor? So interestingly enough, neither one of us has a financial advisor, but we have prepared information from research, as always, peer-reviewed journals, about whether one should hire a financial advisor. Before we get started, I want to thank my Columbia, Missouri tennis group for bringing this question up in one of our after tennis hangouts. And it was mentioned it would be great if you guys could have an episode on whether one should hire a financial advisor. And I said, okay, yeah, that sounds like a great idea. And after that, the discussion really became quite intimate in the ways that we started going through hypothetical scenarios. But the hypothetical scenarios where, let's imagine you're 12 years away from retirement and you have $1.67 million set aside right now. What would you do with that money?
So a very precise and concrete hypothetical.
Right. Yeah. But it was a lot of fun. So thank you.
Just asking for a friend, right?
Hypothetically.
That's the downside of having a PhD in finance. But for the very longest time, I was hiding behind my accent. People were asking me, what do you do? And I would say finance and, hope that I understood fine arts and think like I'm a cool artist and don't ask me anything about the retirement portfolio. So I'm kind of like mumbling through it.
Well, I kind of like hanging out like over drinks and talking about investments and stuff like that. So I actually didn't mind. I prefer that to talking about golf and cars. So I'm all about switching it up into what you should do with your investments when you are hanging out with friends.
Yeah, that might be a Catholic thing. I feel guilty about things. I do not want the responsibility of advising people.
Not advising, discussing.
Yeah, fair enough.
Providing information, I guess, which is what we do on this podcast. But okay, enough of the introduction. Our topic today is, should you hire a financial advisor?
Welcome to Questions in Finance,
a podcast where we translate academic mumbo-jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko Fotak. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related. So why has this question of whether one should hire a financial advisor become a lot more important today than, let's say, 20 years ago, or especially 40 years ago? I mean, ultimately, our parents, grandparents were not as concerned with managing their money, thinking about where their money will come during their retirement years. Your grandpa and your parents had a pension from a company for which they worked for 45 years, and this company invested the money and then provided a payout in retirement. This was known as a defined benefit plan. These defined benefit plans, starting sometime in the early 2000s, started to get slowly replaced with what's known as a defined contribution plan, where an employee contributes the money into a retirement account and manages that money himself or herself. Now you need to think about what to do with the money and how to invest it for retirement.
But of course, we have to quote Spider-Man here, right?
Okay.
With the defined benefits plan, you know the pension that you're going to be receiving. With defined contributions, you have a lot more freedom and you have a lot more power in managing your own money. But with great power comes great responsibility. All of a sudden, you are responsible for your own outcomes.
And that's where a lot of anxiety and stress comes associated with this. The responsibility of managing your money. And then you get to see how you fare against the Joneses firsthand when you hit 65 and 70.
And the United States has always been unique among developed economies. If you look at Europe nowadays, the majority of retirement is managed by governments and by public funds. The United States had a model where historically retirement risk was on firms. And defined contributions plans have started before 2000, but they were usually confined to the ultra-wealthy wanting some supplemental pension. Starting 2000, the majority of workers all of a sudden
switching to defined contribution.
Correct. And again, the big switch is risk.
The risk and the responsibility. So there is an upside potential. You can manage your money well and score it big, but there's also a huge downside potential that you mismanage it and then, end up poor in retirement. The overhanging thing is everybody now worries about it, where previously they didn't worry about it because the pension was set up by a company. So this change from defined benefit to defined contributions is, of course, one big reason why this episode, Should You Hire a Financial Advisor, is important to us today. Another reason is at the same time when defined contribution plans became offered, the slew of options in which you can invest in skyrocketed. You go back to the 80s, to the 90s, what can you invest in? Well, there's your bonds and there's your stocks, which to some people that already sounds like a lot. There's a lot to look at, a lot of analysis to do. Let's fast forward to today. What can you invest in? Of course, stocks and bonds, a mix of stocks through ETF funds, through mutual funds, commodities, crypto, real estate investment trusts, and the list keeps going on and on. These options are now offered with higher and higher levels of risk. You can do 1 times leverage, 2 times leverage, 3 times leverage. The number of options, what you can invest in, has just blown out of proportion. So how do you learn all of these possibilities?
It's a proliferation of asset classes. You have things like cryptocurrencies that didn't even exist for our parents, but it's also proliferation of instruments. And particularly when it comes to retail investors, options have been around for a long time, but you had to be some institutional investor to trade them actively, right?
Yeah.
Nowadays, you can trade cryptocurrencies from your phone. You can trade options. You can trade options on cryptocurrencies.
That's right.
You can trade levered options on cryptocurrencies, and you can do it from your phone while you're sitting on the toilet. And which, I don't know if that's great for your retirement, but that's an important convenience, right?
Convenience, definitely. I was just actually reading about a couple of recent ETFs that popped up that center around founder-run companies. So, for example, like Meta, and Mark Zuckerberg is the founder and still running it. And the idea there is that founders are very involved with their companies and the returns of these companies should be better. Notwithstanding a lot of the academic research that points otherwise, but that's an area for a different episode. From academic research, we know that on average, founder-led firms underperform, but there's been a big brouhaha about how they're great, and here's an instrument for you to invest in.
And it's usually a governance issue, right? These founders have too much power.
It's also an issue of shifting resources into some areas of their companies that are underperforming. But we won't go into, I'm just saying here's a new fad, which really isn't consistent with research. And there's already several ETFs just to cater to that.
So a fad that retail investors should probably avoid. But I would also say you're emphasizing the negative here.
Basically, I did emphasize two things that have brought this question up close, which is number one, now many people are in defined contribution plans and need to manage it. And number two, the complexity of the number of instruments you can invest in now has blown up.
Absolutely. But on the other side, there is a silver lining to increase financial technology. This fintech technology has produced dangerous asset classes that certainly allow retail investors to take risks they don't fully understand. On the other side, it has also produced innovations such as the low-cost exchange traded fund. The counter argument to all of this is nowadays you can acquire a well-diversified portfolio by buying a single ETF, right, that's invested in some sort of index that contains hundreds, if not thousands of stocks. And thanks to the proliferation of the passive ETF industry, you can do so at a low cost.
Right.
So who needs a financial advisor where you can buy a Vanguard ETF?
Right. I completely agree, because in one share, you really diversify across 500 or 2,000 companies.
I think about my own experience. If low-cost diversified ETFs didn't exist, I would probably hire a financial advisor. I don't have time to create a well-diversified portfolio and buy hundreds of individual securities and rebalance. And yet I can achieve all of that at a relatively low cost, at an extremely low cost.
ETFs provide low cost. Actually, some of my friends who actually enjoy investing, they still keep the majority of their retirement savings in target date funds, where you can kind of put the money in and forget, and you know that a portion of it goes to bonds, a portion of it goes to equities, and the mix gets reshifted more towards bonds as you age. We can talk about the advantages and disadvantages, and there are disadvantages of those in a different episode. So even my enthusiasts who love investing, which there's very few of those, they have the majority of their retirement savings in these target date funds, which is a product that didn't exist 15 or 20 years ago.
Of course.
And then they keep a proportion of their money for fun, whereas they invest in certain either individual securities or more diversified approach there.
This is a perfect example of the gray area that we were talking about earlier. It's like, do you have a financial advisor, yes or no? Well, a lot of people self-manage their money, but then they put it into something like this, like a target date allocation fund, which
is problematic.
In itself is, well, it's problematic, but it's also managed, right? The money within the fund itself is managed.
And oftentimes, target date funds actually charge higher fees than other available options.
Yeah, but again, somebody whose portfolio is in a target date fund, would you say, do they have a financial advisor or not? They're not paying a person and sitting down with them and discussing their portfolio allocations, and yet somebody is managing their money. And that's what I meant earlier in saying, when you talk about having a financial advisor, not having a financial advisor, I think a lot of us nowadays fall into some gray area. But in the question, should you hire a financial advisor, yes or no? If hiring a financial advisor means hiring one person, giving them control of all your assets, then my answer is unequivocal. No, you shouldn't.
Well, I'm going to add a bit of nuance in there. We're going to break things down. Even if you hire somebody to manage everything that you have, it makes sense for certain groups of individuals, which we'll discuss later.
We've already discovered, preparing for this episode, that you lean a little bit more towards the yes side of the argument. I seem to lean a little bit more towards the no side of the argument.
Yes.
So today's episode is going to be a little bit different. We're going to take sides. Kate is going to dive into the academic research and the academic evidence that seems to point to the yes side. I'm going to offer the counterpoint to the no side, and perhaps we can alternate. You can tell us one of the reasons why we should have an advisor, and then I'll try to offer one reason why not, and we can proceed that way.
Yeah, I like that. That sounds perfect. Before we start getting to the positives and negatives, would you like to mention a few things about the different types of investment advisors? We will have an episode later on how to pick one, but let's just quickly familiarize our listeners with the landscape.
Today, we're going to take a very broad definition of financial advisor. We have acquired a new highly sophisticated AI platform, and our highly sophisticated AI platform has produced the most robust and powerful definition of financial advisor. A financial advisor is a professional that offers financial advice.
A professional who offers financial advice. I mean, sometimes the parsimonious or the easiest or the simplest explanations are the best.
Fair enough. But let's be clear. This ranges from narrower roles, if you want. These narrower roles start from investment advisors. Investment advisors usually do exactly what it sounds like. They advise you on how to invest your money, usually with an eye on retirement.
And charge a fee for that.
And generally charge a fee. Fees are generally as a proportion of assets being managed. In rarer cases, is an hourly
per hour. Something should be discussed immediately when you come into one of these financial advisors. They should mention right away, how are they charging you?
And there is at least some evidence that advisors that are paid by an hourly fee are less conflicted. So you have investment advisors, fairly narrow remit. A subset of those are registered investment advisors who have, generally speaking, higher standards.
You definitely want a registered one.
Absolutely.
And I think there's one more important thing to check for besides whether they're registered or not.
I think you're hinting at research that shows that whether they're subject to fiduciary duties really matters. Right?
Yeah. So you should check, do they have fiduciary duty towards you? Meaning they will act in your best interest, in the client's best interest.
You're absolutely right. There's one paper, the Review of Financial Studies from 22, titled Conflicting Interests and the Effects of Fiduciary Duty, effectively showing that advisors who are subject to fiduciary duties are less likely to sell overpriced, overly costly, overly risky instruments.
I like the title because they're looking at the conflict of interest. So they're saying, okay, your advisor in their best interest wants to do X, but for you, it's better for this advisor to do Y. These are the conflicting interests. And then they highlight that fiduciary duty is important in making sure that your advisor chooses the best action for you. Though we're going to talk about some things that fall under the radar there.
Sure. Fiduciary duties or fiduciary responsibilities are very important. Aside from investment advisors, you have a second big category, which are financial planners. And financial planners usually take a broader look at your portfolio, and they don't just look at your investments, but they might help you navigate things like real estate purchases, such as planning medical expenses, life insurance, and how to fund your kids' college tuition payments. And then you have another big group, which are financial consultants, brokers, and dealers, which are generally facilitating your trades. And they tend to operate under a lower standard, something that we call not fiduciary duties, but that we call suitability standards. And it is a big difference. Somebody who's your fiduciary has a legal responsibility to act in your best interest. Whereas suitability standards, suitability rules are a lot looser in terms of conflicts of interest. A financial advisor or a financial planner that operates under suitability standards can legally sell you an instrument that provides a very high fee for themselves, that it's not optimal for you, as long as it's suitable. And again, this suitable term hides a degree of ambiguity.
But there's a new set of financial advisors that perhaps they're more likely to do things, I guess, better for you. And these are robo-advisors. This is kind of a new class that came about in the last few years.
Legally, I don't think that robo-advisors are subject to
fiduciary duty.
There are a lot of unresolved legal cases about robo-advisors. Some of that robo-advising industry is a typical example of technology evolving quicker than our legal rules.
Right.
There was one more missing category, which is specialized advisors. Specialized advisors are people like your tax advisor that specializes in one particular aspect of your financial or economic well-being, but doesn't have a holistic view. The point that we are trying to make is that we are casting a very wide net in the discussion today, and the professional that's paid for financial advice is a financial advisor under our definition.
So if somebody asks you to give them access to your retirement savings because you've hired them as a financial advisor, make sure you see whether they're registered and make sure that you check whether they're a fiduciary. Those are very important things before you pass on your money to a financial advisor.
Financial advisors will always try to gain control over your entire asset portfolio.
Because they get paid based on fees. The higher the portfolio you give them access, the more money they make.
And the argument on which they sell you is this idea that in order to properly diversify, they have to have a holistic view of everything that you own. So they're going to always have, a somehow valid argument for why they need control over all of your assets.
I'm going to throw in an anecdote. I do have a friend, actually several, who found a way to sidestep fees that's being paid on the total amount of money that the financial advisor is managing.
Okay. How, Kate?
Let's imagine that you have $100,000 to invest for your retirement portfolio. So they would allocate about $10,000 or 10% of their whole retirement portfolio to a financial advisor. Okay. The financial advisor is going to charge a 2% fee on that. So $10,000, 2% fee is $200 a year. Then they watch what the financial advisor does. These are all actively managed instances that we're talking about, which stocks they select. And usually it's going to be anywhere from 20 to 40 stocks. They talk to them about reasons for the selection, learn things that, are basic investment principles, and then replicate things on the remaining $90,000. So you are paying the 2% fee on money managed by your financial advisor, but you're really allocating holistically only 10% of your cushion to them.
I have learned something new here. It sounds like there might be some ethical implications to doing something like this. You might be cheating your financial advisor. Then again, after reading a lot of the research, it's hard to have much sympathy for financial advisors.
Let's get to the main part of our episode. Let's talk about the pros and cons of hiring a financial advisor. And
absolutely.
I would like to start with a big finding in our literature that has been very consistent, very strong, empirically shown in a variety of settings, that is perhaps going to surprise a lot of our listeners.
Sure. And I think what you're hinting at is my main argument on the no side, why you don't want a financial advisor, which is effectively that most of the research that we've seen seems to indicate that they underperform in terms of sheer investment returns, in terms of sheer ROI, return on investment.
And we take a narrow look at it in finance because we turn this question into not what value does your financial advisor give to you, but the value that's assumed is that they beat the returns of the stock market. And then the question becomes, does your financial advisor beat the stock market? And the answer to that, overwhelmingly through our research, is no.
Finance academics, we're like drunk people looking for keys. Where does the drunk look for keys? Under the light.
Yes, I think that's actually a good comparison. And that's not where the keys oftentimes hide. So we are going today to talk about a very consistent finding in academic research. And that is a question of whether financial advisors beat the market, outperform the market. So that's an equivalent of looking under the light. Where if you ask financial advisors, oftentimes they will start pointing to other attributes of their profession that bring about benefits to their clients. For example, tax planning, psychological advice, discipline, and so on. So looking under the light and what academia has concerned itself with is this question of, does your financial advisor provide you with returns that beat a big financial benchmark like S&P 500? That's how finance research has looked at that question.
Well, we want to talk about performance because it's what we can measure. What we can measure, what we can observe. The downside to that approach is that there are a lot of these intangible services and benefits that perhaps by focusing only on performance we are ignoring. But let us look at performance, at least for a moment. Let's focus or drill down on the beat the market. Because one thing that becomes clear is that you have a benchmarking problem. It does pay off to explain why we look at the market. When you're saying, do financial advisors provide value? You don't want to benchmark some sort of idealized optimal investment strategy because that's not what retail investors do. People don't invest optimally on their own.
Oftentimes, unfortunately, they don't invest at all or hold money in cash. So there's a lot of suboptimal behavior. So you are trying to say, what is the proper benchmark to judge your financial advisor?
And most of the research takes as a benchmark just a passive market index. Oftentimes we see the S&P 500, the index of roughly the largest 500 firms in the United States that are publicly traded. And why does that make sense? Well, mostly because that's the kind of return that nowadays you can replicate. I want to say for free. It's not free, but it's
very, very low. For sure, not the typical fee charged by financial advisors.
Some index tracker funds charge around 4 to 5 basis points. 100 basis points is 1%. So 4 to 5 basis points a year is fairly low. So then the idea is that's generally a lot less than what a financial advisor charges, where you're looking at 100 to 200 basis points a year. So at the very least, you should beat these low-cost index trackers. And even in the instances where financial advisors do beat the market in terms of gross returns, after you adjust for fees and commissions, then they lag the market pretty dramatically. Right? One of the things that makes this argument a little bit hard is that, of course, financial advice is private, and we don't always observe it. We don't unless they share this information with us, right? And we've recently had a big data set floating around that has led to a lot of research.
Talking about the Canadian.
Yeah, and it's a Canadian data set. So let me just mention for a second, a lot of the evidence here comes from Canadian financial advisors.
I wouldn't create such a big separation because a lot of Canadian advisors invest heavily in the US stock market.
There is research that looks at what their portfolios look like versus the portfolios of American financial advisors. The asset classes in which Canadian investors tend to invest, they tend to buy United States-based stocks overwhelmingly. So the portfolios don't differ significantly from those of US-based investors. So we can generalize the lessons from our Canadian cousins. Now, I know you and I differ slightly on this point. I do think that Canadians are morally superior to the rest of humanity.
I definitely don't. I think they're just fine.
Well, there's research on this, on Canadian kindness. And there are actually objective ways to measure kindness. At some point, we are going to get to fraud. I always wonder, are Canadians just less likely to commit fraud? And are Canadian advisors just a little bit more honest?
Well, nobody did that study yet on the fraud of Canadian advisors, I think. Let's get to, does your financial advisor beat the stock market? Let's talk about the outcome of the study.
There are two very highly cited papers in the Journal of Finance by a similar team of co-authors. Evidence here comes from Canadian financial advisors. One was published in 2017 with the title Retail Financial Advice, Does One Size Fit All?
I like that. Does one size fit all? Does financial advice work for everybody if it's the same?
And there are a lot of nuanced findings in that paper. We're going to have to cite it at multiple parts of this discussion. Then there is a 2021 Journal of Finance, The Misguided Beliefs of Financial Advisors.
Yeah, it already has a negative connotation in the titles. The beliefs of financial advisors are misguided.
Absolutely. And in both of these papers, one of the headline findings is how much financial advisors actually charge, because they actually find that when you add up all fees, commissions, and whatnot, you're getting about 2.5% to 2.7% a year, which is probably a little bit higher than some other studies. For example, there are a series of studies looking at mutual funds that are actively managed in the United States. They're finding that their management fee is about 1 to 1.5%. So 2.5 to 2.7 is kind of on the higher range of estimates.
So if you have $100,000 portfolio, the 2% fee comes to $2,000. So yeah, if you have $100,000 that you're allowing your financial advisor to manage, each year they're going to take $2,000. That's the fee.
Sure.
Year over year over year.
And it's easy to miss how these fees add up over time.
Do you have an example?
Well, I know we crunched some numbers, but unfortunately, I don't have them in front of me right now. I know that we were talking about a fictional investor that had a portfolio of about $100,000 and that invested this portfolio for 25 years.
Right.
And we were looking at historical returns of a balanced portfolio of stocks and bonds. We stayed conservative, so at about a 6% mark. If you invest this portfolio, $100,000 at 6% over 25 years, after 25 years, you're going to have, I think it was about 429.
That's correct.
After 25 years, you're going to have $329,000 of investment returns.
Right.
Plus the $100,000 of base, right?
Right.
And then we crunch the same number for a person that earns the same 6%, but then pays the financial advisors a very conservative, actually, by these studies, 1.5% a year.
So we're being conservative on both sides, the 6% return, historically at least, and the 1.5% fee. We're conservative on both of those estimates.
And that same investor starting with $100,000 ends up with $300,000.
So $129,000 less.
Correct. The way I like to think about it is the investor without the financial advisor earning 6%, they have $329,000 of returns. The investor with financial advisors paying a 1.5% commission has $200,000 of investment returns. In other words, the 1.5% commission, which if you're not thinking about it, it doesn't sound huge.
Doesn't.
It's eating up 1/3, or actually more, slightly more than a third of your long-run investment returns.
Right. That sounds a lot more severe than 1%. The 1.5%.
There's magic in compounding, and here it's working against you, right? So from that point of view, financial advisors are costly, right? And that's my main argument for not. But you were telling us something about risk.
Yes. So in order to achieve the S&P 500 return in a way, or a return of a diversified stock portfolio, and still charge this 1.5% to 2% fee, how do advisors do it? Some financial advisors, especially when prodded, will admit to how they do it. And they say, look, we know we're charging fees here of 1% to 2%. We know that our clients expect at least a return on S&P 500. We want to give it to them, but we also need to take our fees. How do we achieve the two? Well, we dial up the risk. We make a slightly riskier investments, higher risk, higher return, and then the higher returns that we earn, we take that in the 2% of the fees. Therefore, providing our clients with a return of S&P 500, keeping our fee, but their portfolios are slightly riskier than an average S&P 500 broadly diversified portfolio. And then the returns are higher, and those returns come out as fees to advisors.
Effectively, they're increasing the riskiness of the portfolio. The riskier portfolio generates higher returns.
Right.
And then in some almost magical moment of market efficiency, they take that return away from you in fees and commissions. And you as an investor are left with the same kind of return. And yet, first of all, let's be clear, generating a higher return at a higher risk level, you're not generating value. Right? I mean, this is a fair return commensurate for a higher risk level. Financial advisors are pushing investors to take higher levels of risk. That does not mean that they're creating value.
Right. But there's research that points to the fact that on average, people take on too little risk, which maybe flows into the argument that in general, why people should choose a financial advisor. That's because they encourage some better behavior, such as if you are sitting in something extremely low risk, like cash, which is not a great idea, the financial advisor is going to shift you to asset classes that provide higher returns. But even more importantly, the paper Financial Advice Does One Size Fit All highlights the benefit of financial advisor from a perspective that they actually get people to participate in the stock market. Obviously related, if you're sitting in cash, you're very low risk, but also low return. So the big advantage pointed out is that they get people to actually participate in the stock market, and they actually increase the likelihood of a household investing in equities by 60%. So that goes from 20% to 80%. So household not likely to invest in equities, wanting to keep the money under the mattress, so to say, is going to start investing in equities because they're working with a financial advisor. So then, whether they're dialing up the risk by investing in something that's slightly riskier than the S&P 500 or not, that becomes a non-argument, because otherwise these people are sitting in cash in something that's extremely low risk. So the biggest advantage of financial advisor is that they get investors to participate in equity markets. And that is going to yield greater wealth over time, especially if the alternative is putting the money under the mattress.
The study that you mentioned looks at the shortage of financial advisors in Canadian provinces after some regulatory changes. So they have a shock. And the numbers surprised me by how massive they were, right? So they have families that don't receive financial advice. 20% have a portion of their retirement funds allocated to the stock market. Of the families that do receive financial advice, 80% have a portion of the funds allocated to the stock market. It's a 60 percentage point increase. It goes from 20% to 80%. Right, it quadrupled.
Of course, big question is the question of benchmarks, because we don't know what is the behavior of a person who has a financial advisor if that same exact person didn't have the financial advisor. We're not 100% sure that all of the changes are driven by the advice of financial advisors. It's just possible that this group of people who tends to hire financial advisors just pay more attention to their retirement savings in the first place, are more likely to invest in equities, etc.
Yeah, there is a big correlation versus causation argument here, right? Because every time you look at the outcomes of people that receive financial advice, in terms of the size of the retirement account.
Emergency funds, they usually have bigger emergency funds. They usually have the up-to-date wills. They also usually end up having more in assets. Actually, I have some numbers to put into this. It's another Canadian study that found that after 15 years, individuals who had financial advice accumulate 173% more in assets. They say the advice group assets were 2.7 times the size of the non-advice group assets.
Yeah. And yet, correlation versus causation.
Yeah. Right? What if this person who had a financial advisor specifically didn't have it? They still might accumulate 2.7 times the assets of some other person.
Sure. The people who choose to have a relationship with a financial advisor are not random draw, right? People that seek financial advice have an above average level of interest in the management of their portfolio, have an above average level of care.
If you think about a personal trainer, a person with a personal trainer generally has better outcomes than a person without. But what if you take that same person who took on a personal trainer and take away that personal trainer, that person on their own, knowing that they want to get educated in this area, understanding better exercises, might have been at the same level. So we are dealing with a big selection issue here.
Just in defense of the study that we just mentioned, and I don't disagree with you, but just that's why they use this shortage of advisors in Canadian provinces, because they claim that this shortage is somehow what we in research would call exogenous. People are not choosing whether to have a financial advisor or not. There simply aren't any available, taking the choice away.
I see.
So they claim to have solved some of this correlation versus causation. Now, whether you buy it or not.
Yeah. So I guess the big positive for why you would want to have a financial advisor is because they get you to participate in the stock market in the first place. They get you to have the right emergency fund and fund it to 3 months, have a will. And moreover, they also help you deal with biases, with like human biases of panic. So one thing that's been shown in research is that people are more likely to stick with a long-term plan and avoid selling their equity positions into a crisis. So people basically stick with a long-term plan. They avoid panic selling when there's a recession coming or in a recession, but they also avoid buying into bubbles. So there's a disciplining mechanisms that financial advisors apply. Not only do they get people to invest in equities, they then also work with personal biases where, when we see the market falling, we want to sell. And when we see the market going up, we want to invest more. They kind of put brakes on both of those behaviors, which in the long term has shown to have very positive wealth effects. So they provide financial planning and they provide guidance on how to stay the course, the long-term course, against our natural human biases of wanting to bail when you shouldn't and wanting to double up when you shouldn't.
Yeah, I have always wondered why the financial industry doesn't emphasize this a little bit more, because to me, this is the most rational argument for why you should want a financial advisor. There's plenty of evidence saying that emotions get in the way of our portfolio performance. We all get emotional when it's our own retirement on the line.
Yeah.
And interestingly enough, you can somehow insulate your portfolio from your own emotions by hiring a professional to manage it.
Right.
Because, of course, the professional is going to be worried about the performance of your portfolio, but their retirement is not necessarily on the line. So they're going to be more cool-headed than you're going to be with your own money.
This almost makes me think about people hiring dietitians or nutritionists, because we're all very careful about what we eat, how we eat, and we have our passions of eating perhaps donuts or cookies or maybe apples and bananas. But if you hire a nutritionist, they're very level-headed. They're just managing your diet along with another 100 or 200 people that they're seeing.
There is an advantage to the arm's length rational approach, and yet it somehow does not feel like a selling proposition. Give me 1% of your assets, I will protect you from yourself.
But I think it makes a lot of sense. I think it makes a lot of sense. I think that is not a big fee to pay to protect a person from themselves with their biases, especially selling in recession or buying into a bubble.
So far, your two big arguments are some behavioral modification benefits that are coming into play here.
Definitely. They're getting people to invest in the first place and then into the equity market. And then once they're in the equity market, they are preventing them from making mistakes, which are humanly typical.
When I was listening to you speak about these risk arguments, it sounds like you shouldn't expect your financial advisor to produce superior risk-adjusted returns, and yet your financial advisor might help you calibrate to an appropriate risk level, which is a benefit by itself. We assume there is some efficient frontier that produces rational risk-return rewards, and yet we kind of wave our hands into where exactly on that efficient frontier should each individual investor choose to sit, and financial advisors, that's exactly the benefit that they provide.
Yeah, and I think I'm going to add about how financial advisors are helping people to be more disciplined. A lot of it comes down to just regularity. They create a meeting once a month with their client, and usually if a client is a family, they come in as a family and they have a dedicated hour to talk about how much they have in savings, in which equity instruments, how those equity instruments perform over the last months. So they get people to actually talk about this on a regular basis and look at what they have in their retirement portfolios and how much they're saving, how much they have saved on a regular basis. So if you think about it, it's like therapy. People go to a psychologist to talk about how they're feeling. Well, nobody ever wants to talk about their money and retirement savings. A lot of the times it's a hush-hush topic, even in families. Here, the family is going to sit in front of a mediator in a way. So I think that's actually a huge intangible benefit right there. Yeah. It's like financial therapy.
All of that is true. I understand that there is some degree of peace of mind that you gain from a financial advisor.
I can hear there's a but.
It all hinges on trust. And there is a big question here whether that trust is somehow misplaced. So, my first argument against hiring a financial advisor was underperformance. My second argument against hiring a financial advisor is fraud. I will cite the findings here. This is a paper published in the Journal of Political Economy in 2019 with the title, "The Market for Financial Advisor Misconduct."
The Market for Financial Advisor Misconduct. The title sounds fascinating. Can you decode it? What is the market for financial advisor misconduct?
The headline is that there is a certain percentage of financial advisors with misconduct.
The first thing that comes to my mind is Bernie Madoff.
Yeah, of course. But the big question is Bernie Madoff a bad apple, an exception, or is it the rule? And how frequently does this happen?
So how frequently?
And the headline number is 7%.
Wow.
And 7% is approximately 1 out of 13 has some sort of conviction against them for misconduct. Now, you were asking about the title of the paper, The Market for Financial Advisor Misconduct. One of the big findings in the paper is that there are specific firms that specialize in hiring advisors with misconduct allegations against them because they tend to sell instruments that produce higher fees and
don't really hold up to the fiduciary duty argument.
Absolutely. And so they actually find that there are some big name investment advising firms where up to 15% of their employees have misconduct allegations.
Wow, that's a lot. So you're saying another argument against investing with a financial advisor is that you're going to put your money in with a Bernie Madoff.
That you have the possibility.
And not a small possibility. Imagine if you're going for a medical test and they tell you there's a 7 to 15% chance you're going to die.
Yeah, you have only one retirement, right?
Yes.
And do you want to take one chance out in 12 that instead of having money for a retirement, somebody's going to take that money and run to Mexico or to some country without extradition?
Or not run, or just do what Bernie Madoff did, lie about returns, and then it goes bust whenever you hit a crisis.
Yeah, absolutely.
So yeah, fraud is a big argument I can see for not investing. Yet I have to say that I think a lot of people feel very anxious and worried about their investment and retirements, and they just really want to offload that worry, and they want a trusted partner. They want a peace of mind, and they want the convenience, which brings me to a counter-argument paper. You cannot find a better title. It's called Money Doctors.
I'm familiar with that paper. That's Nicola Genaioli, Andrei Schleifer, and Robert Vishny, right? It's a Journal of Finance.
That's right. This paper is very nuanced. They say that a lot of the times individuals want to have this peace of mind and convenience of hiring a financial advisor, to not have to think about it. Many individuals, highly educated individuals, even in fields of economics and statistics, actually prefer to not look at their retirement and retirement investment mixes. So they want that peace of mind of a financial advisor. And so what this paper, Money Doctors, does show is that financial advisors understand the importance of trust from their clients to them, as they want to keep a client, because to a financial advisor, that's money in the pocket. They're charging 2% fee on assets under management.
Sure.
What are they providing to an individual? They're providing them with a peace of mind, the things are well managed, etc. But going back to your argument, the Money Doctors paper does show that this trust is so important to financial advisors, and they want to keep the client's money because of the trust between the two, that oftentimes they will listen to their client. The client will tell them something incorrect, but they're extremely convinced about this incorrect opinion. And to not ruin the trust with the client, the financial advisor will undertake actions that are consistent with the thinking of their client.
Oh, that's interesting.
And this is, again, done to not ruin the trust between the two.
So sacrifice a little bit of performance to not contradict. That goes back to our first argument. They tend to underperform. It's interesting that you're emphasizing this. There are some solid reasons why they underperform, right? They underperform, as you just said, because sometimes they have to
not ruin the trust and to do something that the client said, even if they know maybe that's not the best solution.
Which goes back to, we kind of glazed over, when we were talking about underperformance, we kind of glazed over the reasons for underperformance. But one of the biggest findings in that stream of the literature is that financial advisors seem to be extremely momentum driven. They buy stocks that have recently done well, and they sell stocks that have recently done poorly. And we know that this kind of momentum strategy from asset pricing research tends to produce abnormal returns in the short run, but it's a very bad way to manage your portfolio in the long run.
But do they do that only for their clients' portfolios, or do they actually believe in this and do it for themselves as well?
Interestingly enough, there is at least some evidence that they're just as bad at managing their own portfolio, and that they make the same mistakes with their own money as they do with their own clients' money. I was going to talk about this as one of the arguments for why you should not hire a financial advisor, but since you have brought it up, that's that one paper that we mentioned, the misguided beliefs of financial advisors. That's exactly what they're asking. They're asking, are they dishonest, or are they doing so out of a genuine belief that these are market-beating opportunities? And given that they're investing their own money, we can conclude that, well, maybe they are not dishonest, they're just incompetent.
But if I'm an investor, what is the difference to me?
I think there is a difference whether this underperformance comes from some sort of mistake, because mistakes are random and mistakes should average out over time, versus if somebody's dishonest, it means that they will keep stealing if they have the opportunity. So somehow in the back of my head, dishonesty is worse than incompetence. And yet both of them are pernicious. And I was going to use the incompetence as one of my arguments for why you should not hire a financial advisor. But I will say that research looking at underperformance, it talks about these momentum strategies, which are largely driven by herding behavior. As a financial advisor, what's most dangerous for you is to miss out on returns when others are making profits.
Because then money is pulled away from you.
Think of a typical bubble situation where you think assets are overvalued, but everybody's buying. Now, as a financial advisor, you have two choices. You want to be the contrarian. If you're a financial advisor, you might have some negative opinions about the market, and yet you're better off staying invested because the fear of losing profits while others are making profits is a lot bigger than the fear of the market deflating. Because if you lose money when everybody else is losing money, you're not going to lose clients. Where are they going to go if everybody's in the same boat? Contrarians lose clients. That's the unfortunate reality, right? Because again, opposing the beliefs and wishes of your clients is not a great selling proposition, even when you're right.
So I guess that's one way to do it, is just to manage your money for yourself and not deal with all of these trust issues and people pulling out money. If you're a contrarian, you still make a fortune for yourself, and then unfortunately not for others because they wanted to herd on the upside.
But we are losing a little bit of the plot, and we're talking about this money doctor's evidence.
Yes.
Right? And this overall idea that they are providing you with some degree of peace of mind.
Right.
I know that there is at least some research out there finding that financial problems are the biggest reason for marital strife and a big determinant of divorce rates. I haven't seen any research actually mapping the use of financial advisors and divorce rates. So that's your argument for why you should hire a financial advisor.
As it gives you a peace of mind.
So, okay, Kate, the first argument against advisors was they don't beat the market. My second argument is they're fraudulent, perhaps more so than, right? Every industry has a certain proportion of fraud, and yet these numbers, 7%, 15%, right? They strike me as particularly high.
And you mentioned a few things such as fraud, outright fraud, and actual just incompetence on financial advisors for why you shouldn't. So my arguments for investing with financial advisors were that usually people who have a financial advisor do better over time, and they actually invest more. They invest more in equities, and they avoid some of our human biases, such as selling in a recession or buying into a bubble. I'm going to come back and say, it really depends who you are in terms of income. And that should be one of the major driving forces in your decision on whether or not to hire a financial advisor. There are two categories of income distribution where the answer is for sure, yes, you should hire a financial advisor. Right. And I'm looking at two opposite side of the income distribution. So if you are in the high income bracket and also in the low income bracket, you need to hire a financial advisor. The question whether you should or not is really for the middle class, depending on their income and financial literacy. So we're going to actually look at both sides of the income distribution, the high and the low. We're going to start with the high group. So the wealthy individuals, perhaps those with more than $10 million under management, they should get a financial advisor because the benefits of financial advice in their cases are going to be largely coming from tax savings. And there's a paper out there titled, "Do Financial Advisors Provide Tangible Benefits for Investors? Evidence from Tax-Motivated Mutual Fund Flows," that shows that indeed financial advisors take their clients into or steer them away from surprise taxes, from surprise distributions from mutual funds at the end of the year, which are going to be taxable. They also help them properly sell losers at the end of the year to create what we call tax harvesting. So they create advantageous tax strategies for their clients. And oftentimes, these are more enjoyed by the wealthier individuals or people at the higher end of the distribution. But besides this tax planning, Financial advisors for the wealthy provide a variety of other benefits. They help them plan their IRA contributions, their kids' 5 to 9 plans, their insurance, their kids' college, perhaps charitable giving that then helps the kids to get into or stay in a certain college. And ultimately, also networking events. They create these get togethers for 100 or 150 wealthiest families where the kids can mingle and jingle. And this is a lot of intangible benefits provided there, not to mention wealthier families, especially if they're bigger families, get together in one room and with this mediator, the financial advisor, get to talk about what they want, which charitable causes are important to them, how to go about it. So it opens up again a discussion and a kind of like a financial therapy session. So the benefits of a financial advisor for the wealthy, those with more than 10 million under management, are very large, and they don't come down to just beating the market on your investments. There's a lot of these side benefits, especially associated with tax planning, but also insurance planning, children's colleges, networking events, and the list goes on.
And in some sense, I think we're being a bit unfair because there is a sheer benefit to outsourcing labor. In some sense, managing your retirement is work.
And worry, anxiety.
That's true. And for some people, it's fun, but they're probably a minority. For most, it's a chore. And now you're saying if you're wealthy enough to pay for somebody to take the chore off your hands, go ahead, do it. And they might provide other benefits.
Tax planning.
Just don't expect them to beat the market.
Don't expect them to beat the market.
And even there, it sounds like there is a bit of an asterisk. Don't expect them to beat the market, but maybe they will on a tax-adjusted basis. They might actually produce superior after-tax returns, right? I think that was the big message of that paper that you mentioned. And I guess it is my turn then for the arguments against hiring financial advisors. And let me just cite a piece of research that seems to almost contradict some of the things that we said earlier. We said earlier, one of the big benefits of financial advisors is that they help you reach that optimal risk level.
And because otherwise you put yourself into cash and you are invested in a very low risk.
Yeah, correct. There is this big literature finding that people save too little. And we in finance say people take too little risk. What do they mean that people take too little risk? Well, they don't invest in the first place. Keeping your money into cash is too little risk in finance parlance. But there is also this idea that people's levels of risk differ, or optimal risk propensity differs, because they have different conditions in life, different family structure, different age, and that one of the benefits of a financial advisor is that they will help you tailor a portfolio exactly to the risk level that's optimal for yourself.
For your situation.
And that's a big selling proposition of financial advisors. Now, the rebuttal to that is another Canadian paper, or rather, it's not one Canadian paper that we keep citing over and over. Retail financial advice does one size fit all, and that's where the title comes from. The one size that they're alluding to here is actually the fact that when they compare portfolios of people receiving financial advice, they find that they look very similar, right? Which seems to belittle or seems to deny this argument, the validity of this argument that they're customizing. If they were customizing, people would have different portfolios. Instead, everybody has the same.
Interesting.
There are some other nuanced findings in that same paper.
Okay.
They don't say just customization. They also say under diversification.
Right.
I will mention this one because it surprised me. Right. When I'm thinking incentives to financial advisor, I'm thinking they're going to have you buy a lot of things because the more you trade, the more you buy, the more commissions you're going to generate.
Or, they're going to put you in a well-diversified tracker, like exchange-traded funds that mimics S&P 500.
And instead, some of the findings in this literature are that they tend to invest in few securities, and that investors end up with these portfolios that are higher risk than they would otherwise be, which is not necessarily bad, but also portfolios that are under-diversified, which is both bad and between you and I, that's the one thing that I find surprising. The one thing that we know about financial markets is that there's one free lunch in finance, and that's diversification.
Right.
So if there's one thing that I'm expecting a financial advisor to contribute is to tell people diversify. And yet, over and over, one of the main findings here is that these portfolios tend to be under-diversified.
Right.
And again, I think that's a big argument against financial advisors.
Right. Well, my previous arguments that I've made is we are taking all of this into account, but wealthy individuals still would benefit from financial advisors because there's all of these intangibles, sure. Advice on insurance, advice on college planning, advice on charitable donations, tax advice, and so on, and networking events, of course. So I want to add the other side of the income distribution, or perhaps I should say financial literacy, the lower income individuals and perhaps individuals with low levels of financial literacy.
That's interesting. I find that a surprising discussion. Surprising because when I'm usually thinking financial advisor, I'm walking into a big glass office at the 50th floor of a building. There's big mahogany desks and some guy with Ivy League degrees.
That's because you're coming from a US perspective. The studies that I'm going to quote is titled, How Does Household Portfolio Diversification Depend on Financial Advice? And this study is executed in Germany. So it's a survey of German households. So perhaps some of your idea of what a financial advisor's office looks like is more specific to the US. But in this German study, what the authors find is that households with low financial literacy who obtained advice achieved considerably better diversification. So kind of against what you're saying, and higher expected returns than similarly unsophisticated households, meaning their literacy, financial literacy scores are also low, that did not get the financial advice. So the advice effectively reduced the gap between the expert and novice investors and help mitigate some large investment mistakes. So if you are an individual with low knowledge with low financial literacy, and oftentimes it correlates with low income, you should get financial advice, whether it's robo-advice, whether it's tax advice, but you would benefit largely from financial advice. Here, if we are going to look more towards the US, how do you identify yourself into this group? Perhaps if you tend to follow meme stocks, or how do they say it, stonks that go to the moon, or you are an investor that is largely focused on the newest fad, the research points to advantages of getting a financial advisor to talk about where and how your money should be diversified and what you should be doing for your retirement.
Spoken like a true boomer, Kate. That's interesting. I agree with your overall assessment. And in my defense, you pointed at one apparent contradiction here, this idea that we said the overall evidence is that portfolios that receive advice are not more diversified than portfolios that are not advised. And now you said in this particular study, we are finding exactly the opposite. Right. But the big finding in this study are specific to lower income households.
Lower financial literacy household, which often correlate. That's right.
They actually do mention in the same study that the higher financial literacy households, and they identify those as households that already have, I think it's like 15 stocks in their portfolios, they don't benefit from financial advice
at all. That is correct.
So there are benefits, but it's a corner solution.
Right.
In one side of the market. And you started by saying there are these two distinct corners of the market. Clearly, people earning a lot of money who are highly sophisticated are getting this valuable tax advice. On the other corner of the market, you have people with low levels of literacy who are being incentivized to invest in the first place.
Yes.
And perhaps motivated to stick to a plan. That's one of the big findings in this study is that they simply stick to their plan.
Right.
Fair enough. All of this is valid. It's my turn for
the argument against.
This is my last argument against. And in some sense, I feel like I'm reheating the water here because to me, a lot of this starts and ends with performance. In some sense, I was ready to make lunch when we said they underperform. I have my own biases. Why would I pay somebody?
But you're looking under the light.
Fair enough. That's a good point. That's a good way to put it. My last argument comes from a bunch of research articles that find that advisors face very conflicted incentives. We don't want to rely on the well-meaning or morality of advisors. We would like them to have the right financial incentives. It's an industry where the economic incentives are exactly the opposite of what you would like them to be. There's a review of financial studies assessing the cost and benefit of brokers in the mutual fund industry. When they look at actively versus passively managed mutual funds. And there is another Journal of Finance in 2014, Mutual Fund Performance and the Incentives to Generate Alpha. And both of these papers actually lay down what I think is a subtle but important argument and might not be clear to everybody. But there's a finite amount of profit that funds generate. And the funds that distribute profits to their own client cannot bribe financial advisors. The funds that are actually honest and are producing the best returns for their clients, they're not going to be kicking money back to financial advisors because they don't have excess returns.
But their fees are so low.
Because the fees are low. But it's going to be the funds that charge very high fees that are effectively accumulating excess cash that they can use to, let me use the word bribe.
Yes.
And bribe here is what people in finance euphemistically call payment for financial flows.
Yeah, let me flip it for our listeners. I think the best way to understand somebody is to put yourself in their shoes. So our listeners, imagine that you're a financial advisor. You want to get paid, right? How do you get paid? Well, you get paid apparently from advising your clients to invest in
Correct.
funds. So perhaps looking at it from the financial advisor's perspective allows our listeners to understand more what these financial advisors are doing ultimately. How do they get paid? They get paid from higher fee funds, which they advise to their clients.
There is this key element of funds will kick money back to advisors for selling clients their way. And the ones that are going to pay the most are going to be the ones that produce the worst outcome for clients. Right. So again, you're not taking a random draw. You're facing a huge adverse selection component where they're going to push you exactly into the high cost, high fee funds that you should be avoiding. So again, it's not just incompetence. It's not some particular propensity towards dishonesty. It's an industry where the economic incentives are exactly the opposite of what you would like them to be. You have industries where the ethics are aligned with incentives.
Yes.
And you have industries where there's a misalignment. In this case, there's a very substantial misalignment between what's ethical, what's fiduciary, and what's economic and what's going to maximize your payout
for the individuals as a financial advisor.
And as an economist by training, I'm tempted to believe that in the battle between ethics and economic incentives win. And
that's a sad statement.
I fundamentally do not believe in big differences between human beings in terms of morality. I don't think that people systemically different in how moral or ethical they are. I think that people rationally respond to the economic incentives that they have. If you want to look at that as a cynical point of view, then yeah, perhaps it is, right? But I think it cuts both ways. I don't think people do bad things. I don't think people do good things. I think people rationally respond to the economic incentives that you put in front of them, and the economic incentives of this industry are not in favor of retirees and customers.
Okay, we've talked for a while and we've allowed our listeners to hear a lot of the pros and cons of hiring a financial advisor, and we backed all of our discussion by research. But let's conclude. First of all, you should look at who you are in terms of choosing a financial advisor. If you happen to be a very wealthy individual with more than $10 million in retirement, or perhaps a very low-income individual or low financial literacy individual, you should get a financial advisor in both of those cases.
With the disclaimer that financial advice you get looks very different. Right? In one case, it's your expensive boutique firm. On the other side, it might even be the University of Buffalo, where I work at. We offer free clinics for tax advice and even free clinics for retirement planning for low-income individuals. As we said already, there is this big robo-advising industry, which it's new. We still don't know where the research is at. But certainly, we started this episode by talking about why is this particularly timely. I think that one of the reasons why this is timely is because financial advisors in some form are now accessible to a much larger part of the population.
You're talking about robo-advisors.
For 90% of the population, should you get a financial advisor was a totally irrelevant question, 20 years ago, because you just couldn't afford one. Nowadays, that industry perhaps in novel forms, such as robo-advising, has really moved downstream to the point that middle and lower income individuals can get some degree of financial advice.
And the advantage there is that it creates an actual plan for retirement savings. It allows these people to not keep their money under the mattress and actually invest in equities and to stay the plan, meaning avoid our natural human biases to sell in a recession and to buy in a bubble. So those are arguments for hiring a financial advisor, whether you're a high income individual or a low income individual. But one thing that's true regardless of which income distribution you fall into is that when you hire a financial advisor, remember, you're not hiring them to beat the market. They're not going to beat the market. You should be careful if a financial advisor promises to you that they're going to outperform the market.
Oh, that's a huge red flag. Yeah,
they cannot control that. So what should they be talking about? They should be talking about things that they can control. Financial advisors can control costs. So they should be talking to you, your client, in terms of how they're billing you, what is the cost to you, and what is the percentage or basis points that they charge on your assets under management with them. And of course, you want to make sure that these advisors have a fiduciary duty towards you, because we've talked about many things regarding fraud and unethical ways that advisors can behave in. So if you are in the high income bracket or low income bracket, get a financial advisor. It's going to help you. You're not doing it for the financial advisors to beat the market, and you should concentrate on those advisors talking about what they can control, which is costs, not returns and beating the market, and make sure they are fiduciaries. But I'm leaving out a huge group in the middle.
You're right. And where most of workers by definition fall, it's a big middle. And there the answer is a lot more nuanced, because we see that most of the benefits are coming from that behavioral modification side. So I think that the way I would word it, I would say, look, you should be saving at least 10 to 15% of your paycheck to maintain a reasonably comparable life standard in retirement. I would say if you're investing 10 to 15% of your paycheck already in some low-cost, diversified portfolio, then keep doing what you're doing, save on the money on a retirement advisor, and in the long run, that's going to be substantial.
But you need to be careful and not try to sell in a recession, to not try to jump in more when we are in a bubble. You also still, even if you are saving enough, even if you allocating to a Vanguard type broad-based ETF, so a low-cost, broadly diversified ETF, you still need to make sure that you're avoiding human pitfalls.
I listened to Richard Thaler, famous for his contribution to behavioral finance. And he used to say that the best thing that investors can do for their portfolio is open an account, invest money into an index tracker fund, write the password on a piece of paper, and then burn the piece of paper.
I think I also saw some academic research that points that some of the best performing portfolios are those of dead individuals, the individuals who have died.
Because again, they can't make any mistakes. That's entirely consistent. But anyways, so if you are already in that group, if you are saving 15% of your paycheck, if you are putting into some low-cost, well-diversified instrument or set of instruments, then keep doing what you're doing. For everybody else, if you're struggling to have the discipline to maintain that portfolio,
have anxiety associated with it, don't want to learn anything about investments.
Exactly. Or again, not to sound too much like Boomer Kate, but if your idea of a retirement plan is to buy cryptocurrencies and stonks that go to the moon, then our advice is please, please, please get a financial advisor, get somebody to double check and give you a second opinion. In all cases, I would say when you are looking at financial advisors, you have already said, Kate, focus on costs, which you can control, focus on fiduciary duties, make sure that you work somebody that is working under a fiduciary duty standard, not a suitability standard. And again, be conscious of what you're buying. You're buying a menu of services, but you're not buying performance. Nobody can promise that.
Yes.
And be wary of anybody who does. So, as always, thank you very much for listening. I hope you had as much fun as we did in recording this. I hope this can help you a little bit in thinking through this decision. Do you want to hire a financial advisor or not? Please check our Substack.
Yes, we have a Substack.
So stay tuned. And as always, keep sending us your questions at questionsinfinance.com.
And reading our Substack and recommending us to your friends and family and whoever you'd like to.
Yeah, by all means. And if you want to send us some money and some presents, we'll do that. Cheers.
Cheers.